Hello and welcome. Thank you for joining our webinar in relation to mining joint ventures. This webinar forms part of a series of webinars covering current and upcoming topical matters relevant to the mining industry. My name is Robert Hamill and I'm a partner in Mayer Brown's corporate practice. We are joined by my colleagues Julian Ellison from our competition law practice and Mark Stefanini from our disputes resolution practice. I'm going to talk about the reasons for forming joint ventures and some of the key issues arising in joint venture agreements. Julian is going to follow, talking about some of the competition and particularly merger issues, and Mark is going to talk about some topical issues in relation to joint venture disputes. Before we begin, I'd like to go through some housekeeping points. First, at the bottom of your screen, you'll notice there are multiple application widgets that you can use. We are streaming this program through your computer, so there is no dial-in number. For the best audio quality, please ensure your speakers or headset are turned on and the volume is up so that you can hear us. For the best viewing experience, we recommend using a wired internet connection, preferably with Chrome or Firefox browsers, and closing any programs or browsers running in the background that may cause interference. And on that note, let's get started. There are lots of recent examples of mining joint ventures. In 2019, Barrick and Newmont partnered to combine their assets in Nevada, creating the world's largest gold complex. This is a classic example of companies finding synergies in co-location of assets. In the same year, Teck Resources announced the completion of its joint venture with Sumitomo Metal Mining Co. to develop the Quebrada Blanca 2 project, the expansion phase of Teck's copper mining operations in Chile, and a project which we acted on. Juniors with promising deposits have also been increasingly successful in attracting the attention of majors interested in expanding their exploration portfolios. In fact, several large miners, such as Rio Tinto and South32, have explicitly committed to collaborating with junior and mid-tier companies on exploration projects around the world. There are a number of reasons why mining companies may enter into joint venture agreements, which may go from a circumstance where the original property owner does not want to give up its ownership rights entirely and wishes to keep a stake in the property, to cases where it's desirable to have a local partner with good knowledge and connections, or a partner that has mining expertise or familiarity with certain technology, and that will be useful in developing the mining project. By and large, however, the main reasons for mining joint ventures is the need to share risks and, in addition, to share costs. Those risks and costs can also be amplified in mining projects given the time lag between first drilling and the commencement of commercial production, which in many examples can take several decades. Risks are not limited to geological factors, but include political uncertainty, market downturns, development of new technologies, and social and environmental matters. And, as we've seen this year, natural or possibly man-made disasters such as pandemics. Cash availability in the market is dramatically influenced by market sentiment towards the industry, and that's often painted in a negative light. The upshot is that market capitalizations in the sector have been challenged and companies, particularly juniors, often struggle to raise capital. Now, whilst alternative funding does exist in the mining industry, from royalty to streaming to offtake agreements, and even private equity firms have been investing in the sector, given the risks and the costs, many companies have turned, in effect, to either M&A or to joint ventures. And M&A is particularly prevalent in the gold sector at the moment, where a number of companies have combined to increase their heft. But where they don't want to combine but want to exploit a venture jointly, joint ventures play a role. Although joint ventures may be of a contractual, unincorporated nature, particularly early stage ventures, all have the form of partnerships, notably in the US and Canada, because partnerships can give rise to tax advantages. Corporate structures are more frequent in cross-border transactions, especially in civil law countries. Special purpose entities are incorporated to play the role of a vehicle of the project. The main consequence and benefit is that liabilities relating to the enterprise will be limited to the joint venture company, which can be attractive to the parties. Note, however, that in some circumstances, legislation and the courts may allow for piercing of the corporate veil, such as in relation to environmental matters. Another consequence of corporate joint venturing is that title to the mineral property is usually transferred to the joint venture company. In those jurisdictions where legislation does not allow for multiple holders of the same mineral property, this feature will give comfort to the party that would not hold the property if the venture were unincorporated. We'll turn now to some of the key issues for mining joint venture agreements. Joint venture agreements are very often complex agreements dealing with various sets of rules and procedures regarding the exploration, development, construction, production, and sometimes expansion, closure, and even the reclamation of the mine itself. As mentioned, the agreement attempts to cover the life of a mining project and so could endure for many decades. Even for those cases where the joint enterprise does not require sophisticated arrangements, some key issues will inevitably be addressed in the agreement, such as contributions of the joint venture partners, the decision-making process, and deadlock, each of which I will discuss now. Comments in relation to JVAs generally could be mentioned, in particular exit provisions, but this talk is going to focus on specific concerns that I've mentioned above. As regards contributions, the joint venture parties will need to agree on a funding program for all mining operations, starting with scoping studies, initial drilling and resource definition, moving to pre-feasibility studies, bank feasibility studies, and then a full construction program and associated budget. Once the mine is in production, it's normal to draw up an annual program and associated budget, which will still require funding, at least at the early stages. As discussed, funding can come from the parties or from third parties, such as project finance, banks, ECAs, and alternative funders like streamers and off-takers. Each party normally commits to fund its respective share of construction costs pursuant to the applicable program and budget, including any cost overruns. The company will issue regular cash calls against an agreed budget. Funding can be by way of share capital subscriptions and shareholder loans. It's normally a mix of both, as this normally allows for tax efficiency because loan interest can normally be deducted from the profits of a project company. But you normally have to take into account restrictions in tax legislation such as thin capitalization rules. Cost overruns can be a contentious subject, particularly where one partner has a majority interest in the project and is heavily involved in managing the operations and providing the services. The minority partner may seek to impose limits on cost overruns, say not more than 15% of any agreed budget, so as to limit its overall financial exposure to the project. Failure to fund normally gives rise to alternative remedies for the non-defaulting party or parties, such as non-straight line penal dilution, anything up to 3 times the shortfall, the option to treat the contributions as demand loans to either the company or the non-defaulting parties, or an action in damages might be brought against the defaulter. It might have its rights to vote and to income through dividends suspended. Ultimately, persistent default can trigger a requirement to transfer the defaulter's share in the joint venture. There is an argument that a failure to fund cost overruns, which we talked about before, beyond an agreed threshold of 15%, is not in fact default, and that the remedies which I've just mentioned should not apply, or in the case of dilution, should be non-penal. Most joint ventures also include what we call elimination rights, whereby if a party's shareholding ultimately is diluted below a defined level, say 10%, then its interest in the joint venture can be acquired by the other parties or turned into a royalty. Turn now to decision-making. The decision-making architecture for a joint venture agreement will depend on the number of parties and their respective shareholdings. From the classic 50-50 deadlock joint venture scenario to the two-party majority-minority scenario to the more complex multi-party scenario. In certain jurisdictions, the government of the country will also require a share in the venture in return for allowing mining operations to proceed. For instance, in Chile, the government normally takes 10% shareholding in the whole mining operation. This is in effect a free carry. The other party's interests are diluted pro rata accordingly. In corporate joint ventures, decisions are taken by the board of directors, whose compensation will ordinarily reflect the proportionate shareholdings of the parties. In the classic 50-50 deadlock JV, the board will be inherently deadlocked, assuming no casting vote is prescribed. So it's important to include mechanisms in the joint venture agreement which allow for the business to operate even when the parties cannot agree on matters, for which we'll discuss below. In the majority-minority scenario JV, which we talked about above, the majority party will have control over most day-to-day decision-making and will in effect operate the joint venture. The majority party is likely to be the operator and manager of a JV and provide management services, albeit normally on a nil cost or cost-plus basis. Nevertheless, the minority party or parties will normally want to take part in key decisions. Similarly, in multi-party JVs, where different interest faction groups can form and become a majority, the minority party or parties will often still want to take part in key decisions. It has therefore become normal in mining JVs to include what are known as special approval rights, normally set at around a 75% pass mark, and supermajority approval rights, which require a 90% majority pass mark. A typical set of such rights are going to be set out in the next couple of slides. So this slide sets out what I call special approval rights, i.e. requiring a 75% pass mark. And they're the sorts of things that you would expect to see requiring a high level of shareholder approval, such as the approval of the operating plans and budgets for the year, changes to facilities, and large unbudgeted expenditure items. This slide sets out what I call supermajority approval rights, requiring an even higher pass mark of 90%. These are significant matters for any mining project, and the examples I've given are things that you would expect even a minority party to want to have a say in, such as metal hedging activities and changes in distribution policy, changes to the underlying constitutional documents. Finally, I want to talk a little bit about deadlock. Deadlock is inherent in the classic 50-50 joint venture agreement I mentioned above, but it can also arise in the other JV scenarios, which have minority approval rights if those approvals are not forthcoming. Resolving deadlocks is something of an art form and normally starts with an escalation procedure whereby the issue is referred for consideration to senior execs within the party's own organisation. Should that fail, then there is something of a philosophical debate about how best to resolve deadlocks. Some commentators take the view that there should be no circuit breaker in the documents and that the parties should thrash it out. All the joint enterprise will fail, and therefore the incentive for parties is pretty high. Since most mining operations are not divisible between the parties, for instance, the underlying title can't be divided, the parties' then ultimate threat of dissolution is one which should concentrate their minds. I'd say that this school of thought normally argues that deadlock experts and arbitrators are in no better position to decide the issues than the parties themselves, and that circuit breakers such as forced sale provisions and buy provisions tend to favour one party over the other, normally determined by the commercial strength as opposed to the merits of a dispute. Should, however, the parties decide on referrals to experts or arbitrators, a mechanism for appointing them and the terms of their reference will need to be included in the joint venture agreement. Similarly with forced sale and buy provisions, of which there are many exotic variants such as Russian roulette and Texas shootout, will need to be drafted carefully. Deadlocks regarding budget are normally addressed in the short term at least by allowing the board of a joint venture company to operate according to the prior year's budget, pending approval of the current year's budget. At that point, I'll stop and hand over to Julian.
There are two key antitrust considerations that I would like to address in the context of mining JVs. One is merger control, and the second one is more general competition law concerns in relation to information sharing and cartel law. Taking merger control first, a number of merger control regimes will catch JVs solely upon the basis of the parent's group turnover, notably the EU, China, South Korea, Turkey, and Ukraine, and without reference to the turnover of the JV. This has the unwelcome result that merger control can apply, one, irrespective of where the mine is situated, and two, before the mine is productive and generating turnover of its own. Merger control will apply irrespective of the JV form, in other words, whether unincorporated, a partnership, or incorporated. Global merger control tests, in particular the thresholds based on turnover, will typically be applied to those JV parents acquiring control. In a 50-50 deadlock JV structure, both parents will be seen as exercising joint control upon the basis that important decisions cannot be taken unless both parties agree. In contrast, in a majority-minority scenario, the key requirement for control in the case of a minority parent will be the ability to block strategic commercial decisions. That is a question of fact, but will typically cover the adoption of the budget and business plan, the hiring and firing of senior personnel, and capital expenditure if set low enough to catch operational spending. With increasingly high penalties for missed merger filings, and for example the latest EU penalty was €124 million, parties must ensure that they comply with merger filing formalities. Under EU merger control, a JV will only be subject to merger control if it will play a self-standing role on a market. And this requirement has some important consequences. If the mining JV parents market and sell the mine's output, with the result that the mine is effectively a production JV but not a selling entity, then EU merger control will not apply. There are refinements on this principle. For example, it can still apply if the mine makes low levels of third-party sales on the market. While the mine is at an exploration development phase and before extraction, production and sales, again, EU merger control will not apply upon the basis that the JV has no market presence. It must be emphasized that the above types of exemption are not uniformly applied by merger regimes outside the EU. So although this market-facing requirement is important within the EU, it is not an automatic exemption outside of the EU. I now want to turn briefly to general competition law considerations of relevance to mining JVs. The holding of equity by investors in competing mines can raise competition law concerns in two areas. One, the obtaining and disclosure of commercially sensitive information, which I will call CSI for short, and two, the facilitation of cartel activity. Because investors are likely to have board or equivalent representation as a result of their equity stakes, they will often have access to the commercially sensitive information, the CSI, of competing mines. Because investors are often simultaneously engaged in the management of competing mines or the trading of competing mines' output or marketing and sales agency type roles, there is a scope for a potentially anti-competitive dissemination and use of CSI, which in an extreme scenario could facilitate cartel type activity. These practical problems are reasonably well understood in the mining industries, and the practical solution which has emerged lies in, one, a careful internal ring fencing of the holding and management of competing investments, including in particular the use and dissemination of competing commercially sensitive information, CSI, and two, strict antitrust compliance training and advice.
I'm going to talk briefly about some of the areas in which we are seeing disputes arise in the sector. These are, of course, areas where particular pressure may be put on JV agreements, and careful thought should be given to the drafting in light of specific factors affecting the project and likely risks, so as to try and anticipate and mitigate future disputes. The first such issue is force majeure and common cost escalation provisions, or similar concepts implied under the law of the agreement, which have been an issue for many participants in light of the effects of the ongoing pandemic on logistics, demand, workforce availability and operating capacity. We have seen an increased volume of disputes and potential disputes invoking these provisions or doctrines. The disputes can be complex and are highly fact and contract sensitive, but the key issues to think about, which may well be familiar to many listening, are, first of all, what triggers exist? Secondly, whether those triggers have been tripped. For example, is the problem a result of an epidemic or an act of God, or more likely, a change in rule or regulation or act of government or state? And what level of interference is required? Does the action need to result in prevention or hindering or increasing the cost of performance? If so, what effect does the clause or doctrine have? Perhaps it excuses non-performance or diminishes or delays performance, or alternatively changes the economic factors that drive a deal, permitting variations in pricing or entitling parties to recover additional costs. What limits are there on the clause? These might be express or implied. For example, contractual business continuity requirements or the general law of mitigation applicable to the contract. Finally, causation. This is absolutely key in any such dispute. Many of the significant disputes in this regard arise where there are competing causes of a failure to perform, and the pandemic is no exception. parties should be cautious about their prospects of utilising force majeure type arguments where there is a competing cause that would have delayed or prevented performance in any event. In general terms, a party will need to prove that but for the force majeure event, it would have performed, save where it can argue that the particular clause suspends the obligation to perform rather than simply dealing with the consequences of it, i.e. what we think of in English law as a contractual frustration clause. The second area is that additional pressure is being put on decision-making, deadlock and dispute resolution provisions due to the volatile economic conditions affecting many JVs. This creates a heightened risk that many common forms of dispute will arise. These include matters such as price renegotiation disputes arising from volatile commodity prices and the imperative for state parties or local partners to extract value from a project in the short to medium term, notwithstanding economic headwinds. Disputes surrounding the circumstances in which projects may be suspended, mines may be closed or production reduced, and the circumstances in which such action can be taken. And disputes surrounding default of one or more of the JV parties and the operation of the default provisions which we discussed earlier, including whether they are penal in nature. In addition, indexing provisions and how they interact with the COVID-19 pandemic have given rise to disputes. The interaction of an increased likelihood that such disputes will be pursued by a party for economic reasons, and the fact that such matters may interact with cost escalation or force majeure arguments or actions which require an urgent response as a result of rapidly changing circumstances, make the clarity of the wording around deadlock, dispute resolution, and special or supermajority approval provisions particularly important. Each such dispute ultimately turns primarily on the precise wording of the agreement in question and the practical impact and timing of any remedies available in view of the counterparty. It's essential in such disputes that a party has clarity as to how decision-making and any dispute resolution procedures interact, and in circumstances where critical decisions continue need to be made, where there's a substantial ongoing dispute, careful consideration of potential scenarios at the outset are likely to significantly mitigate a non-defaulting party's risk exposure and increase its leverage. Finally, in terms of other trends, we see bilateral investment treaty disputes involving state parties as being on the increase for similar reasons to those I've already mentioned. The imperative for state parties to maximise the return on their interest in a JV. Recent years have seen substantial disputes arise from attempts by, for example, Tanzania and Zambia to levy additional taxes and royalties so as to vary the commercial balance of operations with different levels of success. And decisions which have been seen as favouring foreign investors and stifling legitimate resource nationalism policies have driven changes to the approach to international arbitration and bilateral investment treaties in a number of African states rich in mineral resources. The effects of the pandemic may also allow those states intent on resource nationalism to exert additional pressure on their commercial partners. Examples include things like opportunistic attempts by state parties in OHADA jurisdictions to force JV partners to inject more equity due to alleged undercapitalisation, and disputes over the renewal of licences where commercial terms are attempted, where leverage is attempted in relation to commercial terms. In these cases, it's vital for parties to think about the nature of the protections provided to them by both domestic law and the relevant BITs, as well as any intergovernmental arrangements, and frame their arguments in terms of those protections so as to improve their leverage in negotiations from the outset.
This brings us to the end of this webinar on mining joint ventures. Thank you for listening. We hope you found it helpful, and please do get in touch if you have any follow-up queries. If you did submit questions during the course of the webinar, we'll get back to you shortly. However, if you'd like to be in touch at a later date, please use our contact details, which are currently displayed on the screen. We look forward to welcoming you again soon.